Okay, here we go. All right. Well, my name is Åsa Risberg. I'm a partner at EQT. It's a investment firm, which I will tell you a little bit about in a second. I'm responsible for a global healthcare team based in Stockholm. I've been with the firm for 17 years, and I wanted to thanks Bo for inviting me here. It's really an honor to be on this panel. Topic sustainable investment. I work with deals. I do deals. I invest in companies, develop companies. I'm not an expert on sustainability in any way, but I wanted to offer my perspective on how we work with sustainability in EQT, and appreciate the opportunity. And I say on a personal note, when I grew up, I took a big interest in sustainability topics like environmental concerns, social injustice, and I'm married. I have 3 kids, and now that interest has come back to me in a big way. So I really think it's maybe something that happens when you have kids. I don't know, but I really think that sustainability topics are an incredibly important part of what I think of every day in my daily life. And I think about when my kid eats an apple, what's the pesticide that's been exposed to here, the air that they breathe, and the quality of the water, and so on and so forth. And I think it's important to work for a firm that shares your values when it comes to these topics. And I'm going to talk about EQT in a second, but one of the things that is super important for us at EQT is the values that we are associated with, and I'll come back to that in a second. But just very briefly on what is EQT. We were founded 24 years ago. It was a holding company of the Wallenberg family, Investor AB, that founded the company. Our first fund was 300 million euros. Today, we raised 50 billion euros of capital, so we're one of the largest private equity funds in the world, actually, one of the top 10. And we branched out into different things. So if you look at our business lines in the circles here, private capital, that's a classical buyout fund, and we have a venture fund and other things. That's about 75% of our business today. Then we have a real assets business, which is about 20%, and then credit business that's growing very fast, about 5%. And that's what we have today, and we're growing. And our vision is actually to be the most reputable investment firm in the world. So we carry those values with us when we go out and do investments and every aspect of what we do. We're a pretty big fund, pretty big firm now. We have over 500 people. So again, when you're that big, you can't control what people do. So the values is actually a critical thing of what we do, and make sure that people understand our values and what they represent in what they do when they do investments locally. And as you can see, our firm is pretty focused on Europe in terms of office locations, but we actually have about 50 people in the US, and we have 3 locations also in Asia, and that's where we're growing the fastest at the moment. I think what is unique about EQT's investment philosophy is really, a few things that we try to depict on this page. So one is around, our local with locals approach. That means that we're present in the markets and in the countries where we invest. So we have people on the ground who build local relationships and who participate in the local communities. And that is important for us. We think that makes us a better investor than other people who are not involved in local communities. We also have a huge industrial advisor network that is unique for us. So these are former executives who help us evaluate companies that we invest in, but they also sit on our boards in many occasions and help our companies develop their growth strategies. We want to transform companies during our ownership and make them better. So that's kind of what we say we do. We invest in good companies, make them better. We have a unique set of industry groups. So healthcare is one of them, the one I'm heading. And we work with thematic investments. So we have we develop a number of themes that we like and that we want to invest behind. And one of the reasons that we do that is if we do an investment in, let's say, orthopedic implants or infrastructure software, we want to make sure we know as much there is to know about that sector before we make an investment, to make sure that it's really a good investment, that we really do deeply understand what we do. And our culture is very much value-based. When we're growing, like I said, we can't control what people do. We just want to make sure that people understand what our values are, what we think is important, and the way we should act when we meet people and we do business. So this is quite important. So those are our differentiators, and when we invest in a company, we give them access to pretty much all the resources that EQT has to offer. So that would mean you get access to an industry-leading advisory network of over 200 investment, or is it over 200 executives that we have in our network. We got industrial expertise. We got other portfolio companies that you can interact with. And we got a lot of in-house expertise when it comes to both digitalization and sustainability. So those are all things that we offer our portfolio companies, but we also ask for commitments from the companies that we invest in. So we have over 100 companies in our portfolio. We ask them for commitments, obviously financial commitments, because we want to make good investments, but we also ask for a commitment when it comes to sustainability topics. And this is important because we are so big as a firm that we also take our responsibility as much as we can to impose and motivate our portfolio companies to really make a change when it comes to sustainability. And how do we do that? Well, we have developed something, and my colleagues are here, so I take no credit for this, something called the EQT Sustainability Blueprint, which is a guideline on how we assess sustainability when we go through diligence. So that we have a set of ways of working when we assess companies in due diligence. But also when we've done a deal, what is actually pretty important is to make sure that they are signing up to a number of absolute requirements like the UN PRI, some what we would call basic stuff, hygiene factors that they need to apply to. But then we also set a number of criteria that we want them to live up to, and we increase the hurdle as we go along. But this could be around emission targets, around gender diversity. It could be around reducing water usage and other things. So these are the things that we work with, and then we measure these things along the way so that we can see where are our companies in their sustainability journey. And why do we do it? We think we do it because it's a good thing. We want to make our companies better. And we say here at the bottom of our page, we want to leave a future-proof company behind. And I think it's interesting, like Alex was saying, it takes 4 to 5 years. I think in a private setting, maybe we are better, we're more motivated to do these things than in a public environment, potentially. But it doesn't stop there. I think where it really becomes interesting is actually the journey we're on now, which is kind of the ESG 2.0, which is, why don't we think about the ESG topic and the sustainability topics already at the time of our investment in a way that we should look at our companies and say, what does this company do for society? What kind of societal impact does this company have? And what challenges can it solve for us? And I'm not saying that every company we invest in is going to be, have a solution to a societal problem, but I think actually an increasing amount of them will in some ways. And that's simply because this is one of the most important trends that we're seeing right now. There are two trends that we're seeing. One is the digitalization and it's sustainability. And we want to invest with the trends. We think this is good business for us actually to do this. And so this is what I think is really, really interesting about the type of things that we're doing right now at EQT. And so here's our sustainability framework. And as you can see, we're measuring the sustainability practices. These are all the KPIs on the x-axis. the emission rates and so on and so forth. That, how are you doing on that journey? But then also on the societal impact. How are you on your impact on what you can do for society? And some of these things are easy to measure. Some of these things are much harder to measure, quite frankly. And I want to say that sustainability is actually critical to EQT's long-term success. Now, I'm not a sustainability expert at all. I'm just a deal partner. But I can see this, and I think most of my colleagues in the firm see this as well, if not all. If you take the returns, first of all, we think that investing with a trend is a good thing. It will get us better return than if we don't. We want to invest with the trend, and this is a very important trend. The other thing is the talent. We're recruiting a lot of people every year, and it's really truly a war for talent out there. It's very hard to find people. We're competing with other firms, and we gotta, offer some kind of purpose for the people who work with us, and that goes actually for all levels, all seniority. Obviously, the millennials, it's a big topic, but even for more senior people, what kind of impact can EQT bring on, the portfolio companies? We have 110,000 employees out there that we can impact directly or indirectly. So these are the kind of purposes that we all are aware of and we need to work with. And I think that's, when it comes to attracting talent, actually having some program in place and showing that we're trying to do a difference here is actually quite important. Funding, of course, all the big pension funds are looking for ESG, proof of ESG. Otherwise, they won't give us money, quite frankly. So it's something that we would do. We would fill out all these forms and so on and so forth. It's not the most important thing for us because we want to make a change to the real world. But these are things that we actually absolutely have to do. Then I think deal flow is an important one because we are competing for deals. So every time we try to buy a company in the market, there are at least 3 or 4 other private equity firms who are trying to buy the same company. And so if I'm a CEO of that company, I think it's interesting to know what kind of principle my sponsor would have, so that I know if I'm a CEO, if I come to my board with a proposal for a environmental investment of some sort, I want to know that my board is backing me on that. And I want to know my owner is going to back that investment. And so it can actually make a difference if we have a strong sustainability profile. It can actually make some CEOs more interested in having in us as a shareholder than others. Obviously, it needs to be fit in many ways, but this is actually quite important for our brand and for what we do. So I think this all kind of comes together in some kind of nice vicious circle. And I just want to end on this note that obviously this is an important area for us. The one thing here that I haven't talked so much about is this integrated engagement point, which is, of course, there is a head of sustainability, Therese, and she's done phenomenal amount of work, really taking our journey from where we were in 2009 to where we are today. But in the end, this all needs to be integrated into the firm. And I'm sitting here talking about this. I'm not an expert, but if I'm not implementing this in my portfolio companies, it won't happen. So this is the way we work. We have a central initiative, but we try to be as decentralized as possible in the way we implement things. So that's a little bit about EQT, who we are, where we come from, and why this is important for us. So I'll leave it to the next.
Let's hear a little bit about Norken. Norken is, if anything, even more obsessed with sustainability.
Yeah, that's my favorite slide. So let's see. My name is Frida Sivem. I'm the CFO at Norsken Foundation. We just realized how we should pronounce this in English so that someone can even try to copy it once we go abroad. Norsken is Northern Lights in Swedish. So my background is from the tech startup world here in Stockholm. I worked at a few different tech startups, some that still call themselves startups but are quite large at the moment, but that's more of an image thing. So I'm going to tell you a short introduction about what we are at Norsken Foundation and what we do and why we do it, most importantly, and hence my favorite slide. So this is kind of what has happened in the past decades, which is an amazing trend in the world, and it's all driven by economical growth. And with that mindset and with that knowledge of how important it is, we are obsessed not only with impact, but also with entrepreneurs. I mean, of course, this economic growth has also had some implications. We have new problems, but we tend to have old solutions to those new problems. There are environmental issues and so on that maybe even are caused by the economic growth. So we act in this intersection between tech and entrepreneurship and impact, and we believe in tech solutions because of their scalability. It might be very biased. We all come from a tech background, so we love tech, and by tech we mean software mostly. That's our expertise. We truly, truly believe in entrepreneurship, and because of that drive that entrepreneurs have to actually solve a problem. And if you put impact on top of that, and by impact, I'm not going to define impact. I usually get that question, what is impact to you? But impact in the sense of changing something in society on a societal level in the very end. That's the motivation to actually attack this problem. So that's where we act. So what is it that we act on? What do we actually do? We do several things, actually. We have one founder and funder, and he is a unicorn founder here from Stockholm tech startup world. And he started this foundation 2 years ago, a little bit more than 2 years ago. So being the tech entrepreneurs that we are, we can't really decide, and we pivot all the time. But we have at least these 3 areas that we still are doing. So we have Norsken House, which is a co-working space. We have a few different investment vehicles, and we also have started 2 companies in what we call our own initiatives. And all of these efforts are to enable an impact unicorn. And tech startup lingo again, we are amazed by these unicorns, the tech unicorns, and how they have inspired the tech community here in Stockholm, but in other places as well. Before Skype, Stockholm tech startup scene was not what it is today. You didn't think that you could grow a company to be that big. We had, like, Skype came along, they raised the bar. So we want to do the exact same thing, but with impact. So we want to enable an impact unicorn. That's a company that affects 1 billion people positively. I mean, it's not a scientific term. We just made it up, but that's kind of how we want to view this, and it's a good aim to have. So Norsken House is a co-working space. We have at the moment around 320 entrepreneurs sitting there. Half of them are impact companies. That means that they have impact in their business model. So if they create 1 more unit of whatever they are producing or selling, they create 1 more unit of impact, however they measure impact. Then we also have a few tech entrepreneurs, 1/4, and then we have intermediaries and investors. So we believe in this ecosystem that is created when you put entrepreneurs focusing on societal issues together with tech entrepreneurs and together with intermediaries and investors. And you can really see them feeding off each other. We have also created 2 companies. one is called Clarity, and it tackles corruption, specifically petty corruption, and is launched in Ghana at the moment. Another one is called 29K, and it's working with mental health, specifically personal growth. We also have a Norrsken Founders Fund. That's our investment vehicle at the moment that we raised last year. Is 250 million SEK, so it's not a huge fund, or it's only one if you compare to EQT. But we raised that last year, so it was our founder Niklas Adelbert and 3 other unicorn founders from Stockholm startup scene that has funded this fund, and it's kind of like an experimental fund in a sense. We want to put the spotlight on the entrepreneurs, and as you can see here, we have divided it into one commercial bucket and one market development bucket. And it's because we also know that we need to take the bets that others are not taking. And in the market development bucket, there are a few companies that yet has to prove their product market fit. And usually they are tackling issues that tend to be a little bit more problematic to find that paying customer or the product market fit. And maybe that will never end up being a success. We don't know, but we are willing to gamble a little bit, because hopefully if they succeed, they can really, really improve the lives of 1 billion people. So our main criteria when we invest is impact. So that's the absolute first criteria that all our companies in the pipeline has to be evaluated from. And if they don't show that they are creating or have the potential to create impact better than their competitors that might be tackling the same problem, or if they don't have the potential to grow within that area, we are not looking further, even if they tend to have like financial growth that is just amazing, or potential too. And then we look at the tech, because that's so important that this solution is scalable. That's where we see that you can really affect that volume of people. So we're looking for not a marginal impact, but not necessarily the deep impact if you have to trade it off to the number of people or the massive scale it should have. And of course, we look for financial sustainability. It's a non-negotiable that this company has to be financially sustainable. It doesn't have to be the most profitable one, but it has to be financially sustainable, because we don't want to put more and more money into it. We want them to create more and more impact. Hence, they have to have some kind of financial sustainability. And this fund is focused on the Nordic region. We have actually made a few investments in the UK as well. So why are we doing this? We want to enable an impact unicorn. How are we doing this? We're doing it by the 3 different areas, but what we really want to create with those 3 different areas is also that we want to highlight the social entrepreneurs, or the impact entrepreneurs. We want to make them the rock stars of the tech world, or of whatever entrepreneurial world, because we think that the talent is moving in that direction. And it used to be tech entrepreneurs that were the rock stars, and we think that the impact tech entrepreneurs should be the rock stars, and it's actually going in that direction. We didn't start it, we're just fueling the fire. And we also think that that could really build into this entrepreneurial ecosystem, and hopefully we can then create this impact unicorn that Skype was for us, and more people can get inspired, and we can have this self-serving kind of ecosystem creating more and more impact. So that's an intro to what we do.
Sure, I'm happy to start. So I'm going to point to 3 factors. So 2 I'm going to call as external pull factors, and 1 as an internal push factor. So in terms of the external factors, number 1 is just this magnitude of the problems that we see nowadays. So problems such as climate change, there's more and more evidence that climate change is a real thing. Other problems that exist in today's age are the effect of automation on jobs or data privacy. These large problems which affect society, though their sheer importance means that businesses need to start thinking about them. The second pull factor is not only are the problems big, but companies' ability to solve them are also big. Companies are now much bigger than they ever were before. Companies are highly profitable, in particular in the intangible economy. A lot of companies are scalable and able to generate profits throughout the world. So the potential for very profitable companies to use some of the profits to invest in these issues is high. And also the concern that profits have risen a lot while median incomes have stagnated suggests that companies do have a responsibility to use some of their profits to address these big social problems. Those are the two external pull factors. On the perhaps the more positive side, the internal push factor is that we have better data and more sophisticated approaches to sustainability. So maybe in the past, people thought, well, it's actually difficult to measure a company's impact. When we've seen actually from the two presentations, there are sophisticated methodologies to measure this. Also in the past, we thought about sustainable investing as exclusion. So there's particular companies that we're going to just screen out if they don't tick a particular box. But now what we have is much more holistic net benefit assessments where we're not going to just look at do you tick this particular box, but we're going to look at a company's overall benefit to society and see whether even if you do badly on some aspects, you might actually outweigh by doing better on others. And those more sophisticated approaches are a positive factor towards this trend.
If I can build on a few things, I didn't have the question, so I'm not quite as going to be as fluent as Alex is, but I think the point, we heard about healthcare and tech unicorns, and I feel like I'm in California, except there's females in the audience, which is, and especially the panel, which is unusual. But the idea of disruption and capture that both of you talked about in healthcare, the idea of personalized medicine, and the kind of money we're going to need to do clinical trials on specific genes and specific personalized medicine. If we think about the 1960s, solar technology, I'm not an expert on this, but solar technology had advanced enough such that we could implement it. However, it was too expensive. So we didn't implement it for decades and decades. And now we're in a regime, and this comes back to some of the things Alex was saying, that because it's technology-based and scalable, the winner-take-all kind of idea, the money that's chasing these disruptions is enormous because you can have valuations that Amazon and Alibaba and Facebook have, right? The FANGs, the Facebook, Amazon, Google group, have larger valuation, in some has a larger valuation than the FTSE 100, right? And when you think about that why, that means we're going to see enough capital to go after some of these issues that society cares about because of the capture. Now, there's good and bad to that. But it does mean you can mobilize a lot of money. And I think that in Europe, sometimes we miss the point of how much money is in the innovation economy. The unicorns that are not publicly traded are about $1 trillion now. And they're all in the US and China. There's one in the top 20 in the Netherlands. That's the only in Europe. And then there's one or two in India, right? And those of you that hold just public markets, you don't have any exposure to those, right? And because of that, understanding the landscape here and the opportunities and the high riskness of it, but yet the risk of not putting money in there because the disruption is going to come from these new economy things, whether it be healthcare or IT or whatever it might be, the risk of not having money in there, I think is something that we all have to consider. And while we're considering it, we're having impact. And so I enjoyed very much the presentations.
Yeah, interesting. I think from my perspective, if I may comment, I think our industry, if I think about private equity industry, it's not that old. Our firm is 24 years old. I think the industry is probably, 5-10 years older than that. So I think in our part of the world, it has to do with the industry maturing. Actually, it used to be that, many years ago, you can just go out and try to do good deals and, generate some return. And that's great. People are happy. These days, first of all, the competition is so much tougher. there's so much dry powder in the market, chasing deals. You have to have a differentiation. And you know, I spoke earlier about the two differentiating, you know, themes that we're looking at, and we have sector themes and so on and so forth. But you know, digitalization, sustainability, really macro themes that we think are going to prevail. So I think it's around differentiating yourself in an industry that is maturing. At least, you know, what I see. But then I also think that it has an element of cyclicality as well. This is maybe not a good thing, but I think when it's a little bit like healthcare, you know, when you have enough money, then you start to spend a lot more on healthcare. That's kind of just how it works. So the correlation between GDP and the spend you have on healthcare is very significant. It's a little bit the same here. I think that, you know, once you have a great economy, people tend to have more money and therefore have the capital also to look for more sustainable choices, and hopefully it will prevail even if the economy turns down. But I think there's an element of cyclicality that it's driving it as well. We've had a good economy now for 10 years, and so but I think overall, you know, from where we're coming from, it's a non-reversible trend. I think the you know, the interest for this will just continue, and you know, we see an opportunity to make a difference.
I would say also on a global scale, there are more, not just in our part of the world, there is more money, but in the world, there are more people that have risen from having to deal with these very fundamental issues of not having food or not having education and so on. There are so much more people in the world that have that now, so they can also start to innovate, and they don't have to go through the same journey as, for instance, we have done. They don't have to build a railway that we did. They can just invent something that's faster, cheaper, more scalable, and so on. And we tend then to call that impact, because those old solutions that we are stuck with, they might be polluting, they might be unsustainable in our time, so to speak. So it's also a matter of semantics a little bit, I think. What is the impact and what is not? Maybe it's just the development, right? Maybe it's just smart development or innovation.
Frida, I wanted to ask you, in this context, you're very positive about tech and entrepreneurship, and it seems like you're pretty close to stand a venture capital model, but you have a different goal. Is there also a little bit of a critique here implicit in that the traditional venture capital startup scene does not produce enough of value in some areas, for some countries, for some populations?
I just think that we need like quite a few different approaches to this, and it's quite new what we are doing. We are very humble saying that we are testing this out. We are investing in extremely early stage companies, so it's very much a guessing game. We're investing in what we think is the potential of something. And if you invest in a later stage, you're also investing, of course, in the potential, but you have a little bit more data, so you can make a more, it's not a guesstimate. You can actually calculate what would reasonably happen. So I think there's room for everyone to enter this, but I do think that of course our approach is that if we can just turn more money to this sector or this type of innovation, of course we think that more innovation will happen. That's kind of our standpoint.
Nobody had anything bad here. I think that was the last part of my question. Was maybe suggesting that could be a tiny bit too much. But is there anything that you guys are concerned about with these developments? What's the downside here? Is there something we should keep an eye out for that's not good?
I think there's a downside that sustainability, responsible investment becoming... There's an element of documenting things, right? You always have to document, you always have to measure. So, you know, we don't want to do these things for the sake of checking boxes and documenting things. We want to do it because we want to make sure it has a real impact, like you're saying, on society and on the company. We want to make sure that, we invest in something that can actually have a positive impact. And so, of course, there's always this trade-off that, you have to document, you have to make sure, and everyone is sort of looking for more and more evidence. And I'm really doing great in ESG. Here's my report. Look what I've done, and so on. And also this debate around, so what should the level be? Should it be this or should it be that? What's the definition of this and that, and so on and so on. And you could spend tons of time probably debating definitions and targets, and you can get stuck, and so I think that sort of, let's say, administrative part of it, that's of course not good, from my perspective. So we don't want this topic to be too much of a political topic, if you see what I'm trying to say. I think that would be my concern, but I don't think it's a major concern. I think it's a positive movement that a lot of people have an interest in it, but we just don't want it to be something that people just tick the box and just do and say we're certified, we're good, even though it might be easier from a research perspective that the definitions are better and clearer and so on. Yeah.
Yeah, I have two concerns which touch on some of the things that Asa was saying. So number one is the fact that this might lead to lots of extremism and misrepresentation of evidence. So the sustainability movement is a different way of doing business, and so that could lead to people jumping on the bandwagon and saying, well, the current way of doing business is really bad, we need to change things. And if you want to make a name for yourself, you will just misrepresent the evidence and sort of try to heighten the change that needs to be made. So even some leading academics have written books such as The Shareholder Value Myth, How Putting Investors First Harms Societies and Companies and Investors, or Firm Commitment, How the Corporation is Failing and How to Fix It. These are very one-sided books which only present all of the negative things and argue for big changes, because if your name is behind some of these changes, you become famous. And this is just pervading two main developments which are happening at the moment. So one is there's a large backlash against share buybacks. So these are seen as the opposite of sustainability. And there's a very common statistic cited by a professor at the University of Massachusetts Lowell, arguing that 91% of net income goes to dividends and buybacks rather than being paid in worker wages or invested. But net income is already after deducting worker wages and R&D. So that statistic makes no sense at all, yet it's really commonly quoted. So this guy has been sort of parachuted from the University of Massachusetts Lowell to Clinton's advisor. He's become extremely famous, and this is also why at the UK at the moment they're now commissioning a crackdown on buybacks based on this one non-peer-reviewed article within the Harvard Business Review. The second is, some of you might know, some evidence on the effects of common ownership. So there's one paper published in a journal showing that if an investor holds multiple stakes in many airlines, this leads to stock prices, product prices going up. Now, there's different debates as to whether this paper is well done or not, and I'm not going to put my stake into this debate, but what I'll say is that based on this one paper, there have been some very strong policy proposals, such as to stop investors investing in more than one company within an industry and the like. And again, this is just based on this one paper, but people have their incentives to argue for big changes. So some of the law professors have written lots of articles about this because they want to put themselves in the position of being the expert witness if this ever goes into a class action lawsuit. Other people, without even reading the paper, have written op-eds in the New York Times. And again, this is based on confirmation bias. This is our view that investors are evil. We like entrepreneurs, right? Okay, that they create companies. Investors, they just ride on everybody else's coattails. So if there's one paper trying to purport that investors are doing bad things, let's all latch on this paper and then try to argue that there's a large change, and we'll get famous for doing that. Second concern, I'll be brief on this one, is I mentioned earlier that there's just different mentalities. There's the pie growing mentality versus the pie splitting mentality, and errors of commission, doing things badly, versus errors of omission, failing to do things well. If sustainability is about pie splitting and errors of commission, this is a problem. So if we're going to assess whether a company is sustainable as to whether you've done something bad, like made too much profit or paid the CEO too much, rather than whether you've done something good, such as innovated new products, again, I think this is just going to lead to the pie not growing and just being split in different ways.
Just have one quick, maybe sort of negative comment or concern. So the U.S. is different from this sort of Scandinavian utopia here. We have inequality.
Thank you. Thank you.
We are also paying for your health care. I disagreed with your stat, right? We pay for all the innovation in healthcare via the way the pricing of that comes out. But never mind. We get into the habit in a educated kind of elite way of the feel-good check boxes. Yeah, there's poverty in the United States. There's a huge portion of the population that can't read after going to school. There are all these issues. Where I live in Berkeley, at the University of California, Berkeley, which is a fine school, there's homelessness, there's hunger on campus, students. And we need to make sure that when we think about, the innovation everywhere, no, you can't have innovation everywhere because you don't have markets to support the ecosystem of VC. You can't have startup incubators in places where there's not going to be an exit for them, right? And we need to not forget that this kind of innovation, that technology involves capture of massive wealth by a few, and that we can't forget about the rest of the world that's going to get still not taken care of in these check boxes. And so if you want to say something negative, it's not negative about what we're doing here. It's negative that we need to make sure our check boxes include people that can't participate in this ecosystem, which you just don't see as much here in Northern Europe as you do in other places in the world.
Frida, this seems connected to what you're looking a little bit for those underserved.
Yeah, and it's also very much a journey for us to identify what is really creating impact, because that's why I mentioned earlier, I very much dislike when people ask me to define what is impact, because it's different everywhere and at every pace. So if I try to define it once, people are gonna either hold me accountable for it, or I have to put it in some kind of model when I evaluate, and I have to do it in different markets. It's impact something different, and depending on what the solution is and depending on what the problem is. So we are very much on this learning curve when we are looking for this expansion, for instance, into African markets. We are looking into what is impact there and what is really, where can we really contribute the most? What would actually be our contribution to that ecosystem here? It's most likely not making a copy of what we do in Stockholm, but it's also most likely, even more likely, not what we have in mind without going there, without talking to people on the ground, being integrated in the ecosystem and actually having local staff defining that for us. And that also goes for our investments. So as we mentioned earlier, what is really an impact company? Now we invest in very small companies, but it could be that a company traditionally not, and it could be a big clothes manufacturer, if they make massive changes to their supply chain, they could really have such a much bigger impact than any of our companies will have, even if you give them a time frame of 10 years. So it's always up to the specific case at this point, at least for us in the learning curve.
Can I just add a positive follow-up to that? So I think history will record the impact movement as a reaction to ESG in this sense, right? We heard a number of people before in the panel before, the prior panel from this morning, it was interesting, talking about G, right? Some people view ESG as not being successful in creating new impacting investments, if you will, right? That maybe we're doing right by the shareholders and what they care about, and we may be able to affect firms, but we're not changing the world in these sort of ways that we would like to see pressing. And so the impact movement and the terminology comes about from trying to make those changes. And so what we're talking about in this panel, a lot about private markets, I think is really first order on seeing material change. And that concept of materiality that you were talking about, Asa, was super interesting. And materiality in returns, which is what SASB, those of you that know about SASB, is going after, and materiality and impact. And we should parallel those terms, and those are wonderful ideas. So I think the private markets is something, not just because of the unicorns being there and the innovation being there, but also because the new impact, I think, is very much going to be central in the private markets.
And I think also, just also building a little bit on, I remember what you said in your opening about this sort of market being perfect and fixing everything. When it comes to these topics, I think we also have to recognize, that we're all part of, one society. We can all contribute a little bit here and there, but nothing is going to be resolved by, private equity or, impact investment funds trying to make it. We can try to make a bit of difference, but a lot of the things that we're working with in society are in the hands of politicians, and so I don't think that we can solve, problems. We shouldn't assume that we can solve everything, right? But I think we all have, in Sweden we have a little bit of this stakeholder thing, right? We're all part of the society, and we all should and will participate and try to make a difference. But there are a lot of things that absolutely can't be solved by market participants, right? And I think that's just something we need to recognize, that this is nothing. We're doing this. It's sort of something that helps, but it's sort of it will never be 100% in the hands of the finance world. Luckily, perhaps to change the world, right?
All right. I have a bunch of other topics, including the differences between being on the stock market or acting in the public company sphere and more private. But I saw a couple of hands waving. So why don't we make room for a couple of questions or comments if there are now, and then we can get into the contrast with the public afterward. Yes.
Yes, thank you. Very interesting discussion. My name is Adrian Perels. I'm working as an economist in the Finnish Met Office on climate change impact assessment. My question is on, given a comment made by Alex Edmonds on that possibly non-financial experts are not always overseeing the consequences of the sort of the recommendations they make, if I may sort of summarize one of the comments you made. A flip side is, however, what I see if it comes to appraising climate change risks, for example, and it may also relate to some other risks. What are the limits of ability of the financial world to appraise risks that in fact are generated outside this financial world? How do you deal with this interaction, and how well is that, and to what extent may there sometimes be wrong appraisals at that point? In that sense, there is also a bit of a difference between the challenges and opportunities of climate change and, for example, the opportunities of artificial intelligence, for example, even though both can be both risky and opportunity rich. Because your comment on, well, like a juridical expert commenting to some operations or opportunities, I had the idea, okay, but the opposite happens as well. You, as a financial system, you may not appropriately appreciate some of the risks that may be related to underestimate them or whatever in how it propagates through the financial system. Also, in the discussions I've had, I sometimes notice that. So how would you deal with this information logistics, and how could you see methods, both in terms of information collection and in terms of exploring that kind of new risks that would make it more efficient to use this kind of new information?
You're taking?
Thank you for volunteering me. I'm very happy.
You were right.
Okay. Yeah. So if I understand the question correctly, it's the concern that potentially financial experts who are making these decisions may not be fully able to appraise climate change risks. So one thing that we do, Royal London Asset Management runs 5 sustainable funds. I sit on the External Responsible Investment Advisory Committee. So we have an external committee with 4 people. I'm the governance executive pay expert. One person is the expert on healthcare and pharmaceuticals issues, and one is the expert on environmental matters. So we have an external expert. We recognise that the fund management within Royal London, their expertise is stock picking. They're not external things such as climate change, so we have an expert to do this. And one thing we may well do is release a position paper giving Royal London Asset Management's views on climate change. So one of the problems with sustainable investing is you can always rationalise an investment after the fact by saying, okay, maybe it's not doing well on these dimensions, but it's doing well on the other dimensions. There's this book, 7 Habits of Highly Effective People by Stephen Covey, who says rational lies is another way of saying rational lies. So you can tell yourself lies by saying, well, actually, we think this stakeholder is more important than the others. And given that CSR has so many different stakeholders, you can always just reweight your stakeholders. So by having a position paper before the fact, by saying, well, here are the different dimensions of climate change that we're going to evaluate, that's a way of trying to hold ourselves accountable to it.
The materiality, I'm going to use that word again, so that, the SASB movement from Bloomberg in the U.S. argues off of the Supreme Court that any information that a public corporation has that's material must be disclosed to stakeholders. And the idea of SASB, which there's European movements this way too, is that anything material from the corporation point of view, how you use water, what your supply chain looks like, how your labor are happy, or what, all of this, according to that Supreme Court ruling, must be disclosed. Once you get disclosure, then the markets price it, right? You have to put a little bit of faith in the ability of money to be efficient in pricing something once the information comes out. As we go forward, this idea of materiality and getting more information out there so we can understand what is material for returns. Is water material for returns? It's certainly material for impact. I think this is the way forward in making sure the markets value appropriately your concern for climate risk, is going after materiality and more disclosure.
All right. Yeah. Oh, I have 2 more questions over here. Can you turn on your mic?
Okay, so materiality is a very interesting concept, right? The difficult thing is what's material for an oil company is not material for, an agricultural company, which leads to the approach within most ESG raters and agencies to sort of have one materiality for one industry and another for another, and going for the sort of best-in-class approach, meaning looking for the best oil company, looking for the best mining company, whatever that is. That means ESG potentially can only be effective on the margin, right? Can ESG really help us, let's say, make the radical changes that we need, if it's only about finding the least bad oil company?
So I don't fully get that argument in this sense. So say I'm an oil company and I'm worried that I'm not disclosing something material because, being from the U.S., my shareholders will sue me. Yeah? And so I have to disclose my information about whatever it is that I'm doing for my oil company. And so then you get into this equilibrium where the oil companies are all disclosing things that we, ESG investors, might care about, and you can sort ESG investors along those lines. Well, now let's take us back 5 years ago, and Alex writes a paper about the S in ESG, and everyone goes after companies that are not complying on S, and then we have companies implementing better labor practices, and we've changed the world. Yeah? Isn't that what we want to do, is get this disclosure to force, and whether it's your long horizon investors or the hedge funds, you know, we maybe don't like the idea of dividing up returns to the hedge funds, but someone going after the fact that your oil company has a disclosure showing this not as good is going to make your oil company try to do better so they get the checkbox. And then we've done something good for the world. Whether we all have made money off it or not is not the point.
Yeah, I mean, that's perfect, making an oil company a little bit better. Right?
Yes.
Great. But, you know, looking at the trillions of dollars we need to invest every year to transform the economy into something sustainable, doing things slightly better on the margin, maybe it's not what we're looking for. Is ESG really the financial vehicle for
No, so that was my second point my point from earlier about impact investing, right? I mean, if we think about what's going to change pollution in terms of cars, right? We're talking about oil, probably the smart cities. Okay, so who's going to do that? Well, it's not the oil company, right? But it's going to be a different, whether it's the innovation economy, whether it's General Motors, that, or Uber, right? That comes out of a different bucket, but that doesn't mean I don't care whether the oil company is dropping the oil in the North Sea or not. I do. So we need all the pieces, I think. I don't think it's just at the margin. I know I'm picking examples that make it sound like I'm saying something bigger than I am, but I think it does matter. I think all the margins matter.
Yes, no.
This is a question I think mostly for Asa and Frida, although if Adair and Alex have thoughts on this, I'm curious too. In thinking about societal impact, does it matter to you whether this impact would have been generated or would be generated absent your investment as well? So in other words, do you think about additionality when you think about making that investment?
In our framework, we do have that assessment, but just as any other assessment around impact, we have plenty of other parameters as well. It's very much a guessing game. Also, for several reasons, I would say. First of all, the companies we invest in are quite small, so they don't have any societal effect at all now, anyhow, and not in the foreseeable future. They might have very much a positive impact on discussions and mindset and so on in small areas. It could be in the Stockholm investment group, or it could be in the Stockholm tech startup scene, but it definitely does not go further than that. It does for other companies, though. So it's very much assessing something that's not even there now, and whether or not we will then in the future, would this have happened anyhow without us? Yeah, could be. And some cases are quite clear. And especially when you see that some of the companies we invest in have plenty of other investors. Hence, they don't need our money, but apparently they need something else from us. So we are very much focusing on highlighting these entrepreneurs and the issues that they are solving and the ways that they are working to inspire more to do the same. That's one of our major goals, to highlight these entrepreneurs and their innovation scene, so to speak.
Yeah, and the way we at EQT, the way we work with these things, if you think about the sustainability progress, we measure year-on-year progress in our company. So you could say, and there is, reports this every year in back to our investors, and of course you could say, well, that progress could of course happen anyway, absent our, involvement. But we like to think that we challenge our companies and we find ways to motivate them to improve and be better and put more ambitious targets on, targets for them that they can then overshoot. So would like to think, I think the other thing is, if you think about the societal impact, And there you can have more of a philosophical debate whether or not our investment, would they have done, the same thing without us. So if you take a company, we invested in a company called Certara, for instance, that does biosimulation software for pharmaceutical companies. So what that means is that they have a software that can calculate the way a drug acts in your body, and that way you can simulate what will happen in clinical trials. So you can actually bring drugs to the market much faster using that software. So we found the company thought it was really cool. I think the societal impact that has is a very positive one, bringing more drugs to the market quicker. Now, if we didn't invest, someone else would invest, and they would probably do fine. But what our ambition is always to come up with what we call the full potential plan, try to accelerate the development and try to put more resources behind it so that it can go even faster, faster than what the case was historically. So that's our ambition, and then I think our investors will judge us whether or not we're successful enough, but that's our ambition anyway.
I think Jessica asked a very important question. This is one of the big debates about sustainable investing. Is it sufficient just to pick good stocks, or do you need to engage with them and generate incremental benefit? And I'll actually make a pitch for the argument that just choosing stocks based on sustainability itself adds a lot of value. So if you're choosing stocks based on long-term impact rather than short-term earnings, what you do is then you insulate management from the need to always hit earnings targets, because management knows that their anchor shareholders are going to be evaluating these long-term prospects. And similarly, if you know that you have an investor who looks beyond earnings and will sell your shares, even if you've generated high short-term profit, because they know that you've mortgaged the future, that will make a manager think twice before pursuing short-term profit. So what do you do? Is it either stock picking or is it engagement? I think it should just depend on what the fund's comparative advantage is. There's some investors, let's say the equivalent of Peter Lynch or Bill Miller, who are really good at analysing a stock's fundamentals. So when Peter would choose a company, he'd go down to the retail stores and see how customers and workers are being treated. You have other investors like Jeff Ubben, who really know how to engage with companies. And I think some of the dangers of regulation, such as stewardship codes, is that they have a one-size-fits-all approach to stewardship, is that maybe voice engagement is the only way that you should engage in stewardship. Exit or monitoring is not the way, whereas some of Laura's work shows that actually both mechanisms are used together. So what we should encourage is that investors to use what engagement mechanism, or sorry, what stewardship mechanism best fits their core competency and comparative advantage.
Yeah, I will just add on, of course, when we look at what we spend our foundation's money on, we do a little bit more diligent assessment of that additionality. We don't want to go in somewhere, because most likely if we go in and creating this ecosystem, if we do not add value, we most likely take away value created by someone else. So it's not just a neutral alternative, is that we're actually destroying something that's already there. So that's super important once we evaluate the whole affairs of the whole foundation, not just like the specific investment in a company.
All right, great. We'll make time for a few more questions. Did you get an answer to your, was that what you were after? Yeah. Okay. Yeah, we'll make room for a few more questions. I have just two more rounds of things I just want to test on the panel. The first one is comparing a little bit being a sustainable investor as an actor in public markets and in private markets. Here's one case for why it will be easier for private firms or private investors to be sustainable. In the stock market, it's not enough to find a group of firms who for some reason have better performance than all the other firms to make money. You also need to find out before everybody else. If you find out, but everybody else already knew for 10 years, then you're not making any money for yourself by buying those stocks. Perhaps it's a little bit easier if you're acting in the private market to sometimes find firms where there's some great benefit potential, and you can grab some of that. And so maybe it's easier to make money looking among sustainable firms if you're acting in private markets. This could be wrong. That's just one way it might work. But I mean, it's interesting to notice that both of your firms are acting in private markets. Do you have thoughts about this at all?
Yeah. I think it was interesting. Alex was saying that in his research, it takes 4 to 5 years before you can see the sustainability impacting the returns, right, on the public market, if I recall it correctly. So that would imply that as a private investor, you have, more opportunity. If it takes that long, and you have at EQT at least, you have, a holding period between 4 and 7 years, sometimes longer. You have plenty of time, right? And therefore, that should be good investment for us to do that. So that I think is interesting. I think, on the public side, though, I would probably argue that, good and even in the private market, by the way, good companies are better than they seem, and bad companies are worse than they seem. So that would tell you that if you have a company on the public market doing good sustainable work, having then potentially outperform the market, they will continue to outperform the market because they're just a good firm with a good culture, and they will continue to do well. And equally, I think that's the case, at least we're not a turnaround investor. We like to invest in good companies and make them better. So I think the history will tell you a little bit about whether or not there will be, the sustainability investment will make sense or not. If you have a culture that can, culture and leadership and, a platform that can make it work, or if you don't. And that will sort of make for at least us a gating item whether or not we would pursue an investment or not. So I don't know if that makes sense or not, but I think it's potentially it's easier in the private environment because we're working with a long-term view, but it shouldn't be an excuse, so to speak, not to do it in the public sector. Because in theory, it should work there as well. That would be my view.
My view on this is that, we in the public markets, we've the amount of long horizon capital as a percent of capital in public markets has increased drastically in the last decade. With the market, the large pension funds, and a lot of them are here in Northern Europe, are enormous, and they're long horizon. So looking for horizon arguments of public versus private markets, which is what we used to do, right? Investing in VC and private equity is a lockup. Realistically, the pricing in the public markets, I know we like to talk about short horizon and earnings this and that and the other, but realistically, there's so much long horizon market money in the public markets, I wouldn't play that bet. To me, the difference is and I could be wrong, but the difference is risk. In VC, in early stage stuff, 1 out of 15 investments has any material return. And that's a big return, if you're good. That's not an appetite everyone can take, right? Knowing that a lot of the funds, even at the fund level, once you aggregate portfolio companies, the fund level, the returns are going to have that massive skew, and you're going to have to be responsible for to your pensioners, to your whoever, the money you're responsible to, right? That risk is something that investors have to be prepared to understand to invest in these markets. And a lot of times, long horizon investors like to argue about, the academic community on large horizon, on the private market investing, like to argue about performance. And they say, oh, VC, if you take out the .com in the late 90s, that VC is not profitable. Well, but doesn't that miss the whole point, right? If you happen to be if you were a long horizon investor, you would have been invested in the .com, and so the fact that the performance has ups and downs in these markets misses the point about why you would invest in these markets. And so if we're thinking about the innovation ecosystem and the difference between the public and private markets, I think we do need to think about risk as much, if not more, and risk as an upside, not necessarily just a downside, than horizon is my view. But I'm not getting a
Well, I mean,
happy
think,
look from that.
No, I don't really know. I think the biggest risk that we take on, I think, is the risk of something blowing up, right? If there's a risk, so I think we the first thing we do when we invest in a company, we go and check everything. Like, is our plan, is it sort of what we thought we were going to do? Are the things that the way we thought? And if there are potential improvements, we would correct them immediately. We would do it right away, because now is the time. Now we have committed all this capital, so why not commit a little bit more just to make sure that there's nothing blowing up here, because we can't afford to have one company going down. So if that's what you mean with risk, I think I would 100% agree with that we want to eliminate the risk, and therefore we would take all the sustainability measures that we can in order to make sure that there is nothing blowing up, no sort of corruption scandals, no emission scandals, no nothing, right? And then have a more forward-leaning sustainability agenda going forward. If there's something that's really bad, we probably wouldn't invest in the first place.
No,
right?
but you're talking about risk management, which is great. Risk management in a sustainability sense, and I think that's first order for private companies and public companies. I'm not saying that. I'm just saying for the Swedish pension fund, whether one VC fund or private equity fund or a portfolio company, whether they fail or not is kind of irrelevant in a long horizon investment. You may care, right? But these big pools of $1 trillion in capital not being involved in these markets, I think, is also risky. Not being involved in the innovation ecosystem. And so thinking about, the long horizon lockup versus the long horizon lockup, the lack of that in the public markets, I don't think that's as much the first order pressing issue for people deciding whether to invest in public or private markets. I think understanding what their materiality of impact is, public and private markets, and then understanding whether they have the risk appetite for public or private markets. Is fine, but I'm not disputing you at all.
I'm saying what you're saying. Yeah, I agree. Yeah.
I agree with Adair. I think it's quite easy to overstate the differences between public and private markets. For example, there's the view that, public markets are too short-termist, therefore if we're Elon Musk, we need to claim, I need to go private to stop short-termism, which itself is kind of ironic, because his company is loss-making, yet public markets are valuing his company at several tens of $1 billion. But if indeed the view is that, your shareholders are too short-termist if you're public, you can do something about this. So this is why Paul Polman at Unilever spent a lot of time just communicating the strategy with the anchor investors. So when Kraft came over with their takeover bid, shareholders weren't interested. They walked away, because they were committed to Unilever's long-term strategy. And indeed, the same is true for public asset managers. So just like you have an agency problem between company CEOs and asset managers themselves are accountable to asset owners. So the way indeed in which asset owners and asset managers structure their mandates can allow some of this long-term behaviour. For example, the Environment Agency Pension Fund within the UK, they state, what are we going to hold our asset managers accountable for and what are we going to ignore? And they say, we're not going to look at short-term performance measures, but we are going to hold you accountable for various dimensions of stewardship. And so those are ways in which you can even as a public investor, have a long horizon, even if you don't have the locked-up capital that a private investor might have.
Yeah, you have a question about this? Go ahead.
I just want to add to it, Angelica from LDC Partnership. If I connect what you all are saying to where we have the facts about the shareholders maximizing all that value, the 91% that we were talking about, and the distribution between wealth and productivity since 50 years ago, because that's when we started that process with the big, large corporations wanting to prioritize the shareholders. If you look back into that perspective, and then you roll over until today's facts that we have increased the undistributed wealth of the market. That might be one of the reasons for why we have the increasing populism and then we might have the political dimension that I would like to include here before we end, because that is a lot of the big S and the big G aspects that we need to work with, because it involves all of us in all the countries, not only in Sweden or in the Nordics, where we have perhaps an utopia compared to other more areas like California, where we have a lot of poverty. So if we add that dimension to the discussion, the politics dimension, where would we be heading towards?
Americans can't add politics to this conversation.
So I understand the question is, we've seen rising profits, but not necessarily rising productivity.
Or distribution of wealth.
Right. I think my answer to this is always just to look at the evidence. So what we can look at, we've seen these time trends, but there could be many other things driving the time trends. But there is a study looking at what happens when shareholder activists come in. So activist hedge funds, they're seen to be the epitome of what's evil about investors. And so there's a series of papers by Alan Brav and Wei Jiang, which the first paper showed that when they come in, stock prices and profitability go up. But you might think, well, that's due to financial engineering. So they wrote a paper in the Review of Financial Studies, which shows that actually productivity, total factor productivity goes up, where they get census data of plant level productivity. And you indeed still might be skeptical, because productivity could go up because they could work the workers longer hours and pay them less. But they actually looked at labour productivity, and they showed that that went up despite hours not rising and wages not falling. And if we think about like who gets profits, these are investors. And I know that the public likes to caricature investors as nameless, faceless people, but in fact, investors are pension funds saving for retirees in the future. There's a big crisis in the UK because the university's pension fund is going potentially bankrupt, and so professors go on strike, and therefore students demand their tuition fees back. The societal implications of a society which moves away from investors and sees investors as evil are a bad thing. It's indeed important for governments to try and have policies so that everybody benefits, and so I think schemes to try to encourage broad-based participation in the equity market through tax incentives, perhaps companies giving broad-based stock plans, not just to executives but to employees. Those are better ways. But notice those are all pie growing ways, growing the pie and allowing everybody to benefit, rather than saying, no, if you make too much profit, then you're a bad company.
Do you want to engage with that? Any of the investors?
I very much agree with the general concept of the pie. I think that's sort of at least from our perspective, that's how we think about life as well. But I would say, I would agree with you that I think we can't pretend that there is no politics, no gender, all these things are very much present. And, if I speak about EQT, we're a big firm. We get a lot of eggs in our face because we're private equity, because, we invest in schools and so on and so forth. And we've spent a lot of time talking to politicians, trying to educate them about what is private equity really. What are we trying to do? We're trying to build good companies. Here's what we're doing. Here's our sales growth. Here's our employee growth. This is how it looks, after we own the company for 4 to 5 years. And this is what it looks after another 5 years once we exited the company. And it's good. It's a good message, but it's very hard to come through in that political debate. There's very few people who would, win any political point, endorsing private equity at this point, unfortunately. But, I think the one thing that is very high on our agenda, which is not political per se, is the gender topic and something that we really are trying to promote. And that's also difficult, but there we've gone about it in a different way now, policing a little bit, saying, you have to do this. You have to put X amount of people in your boards who are female or minorities, language, gender, all these kind of things. And that is, I think, something that we're having some success with, but it goes very, very slowly, actually. I don't know if that was an answer to your question, actually. But,
can I say one thing on the politics, just real quick? I was in Norway at the Ministry of Finance before here, and we were talking about country tilts, and people's politics always come into this. And, you know, it's fine if you make up a country name and you don't want to invest in that country, for example, right? It can be a big country or it can be a little country. It doesn't matter. That is different than saying what the country risk is, right? And as an institutional investor, as an investor of capital, I very much need to understand that if I adjust my investments in a way that's not risk-based, I am taking an active decision on the behalf of my constituents, whoever they might be. I always like to use the example, because it's a poor state in the U.S., the teachers' pension fund of Alabama. The average salary is probably $30,000 that these people make in their lifetime, you know, every year. And it's not much, and you care about the performance of that pension fund, because it's just really very important to be able to pay the retirees and to not take it from the current workers. And so the performance of that, if you make a decision that you don't like someone's politics, that's not a risk-based decision. I'm not saying I don't agree with that decision, but as responsible asset manager, I need to be careful, because that's an active decision, right? And so we just need to weigh that. And that goes to private equity. We can say, you know, historically, there might have been a period in the 80s where lots of people got fired after private equity hostile takeovers, and they got a bad reputation. That is a generalization that we don't need to necessarily carry forward. And it's not, and deciding that private equity is bad based on something like that may not even be true, and your perception of whatever the politics may not even be true, is an active decision that you're going to have to justify to those teachers of Alabama. And so I think we need to be very, very careful about risk versus opinions. I hope that came across well. I'm getting in trouble here, but I
agree.
Right, I'm like,
Yeah, no, we can't go any closer to politics. We have time for maybe one or two questions if they're not too long. Andreas, did you want to ask?
Yeah, I wanted to share a reflection of a senior sustainability reporting professional and then ask a question to the professionals. So this person says it's very easy to do corporate sustainability if you just cherry pick the right topics. In other words, even Unilever doesn't report on all material topics, like they don't touch affordability of products, for instance. How would you force your investee companies to actually deal with the challenging issues rather than just with the easy ones?
Supreme Court. Seriously. No, I'm serious. The Supreme Court rules it. The U.S. companies follow. The European companies have to follow. The Asian companies have to follow. I'm serious. The Supreme Court. Yeah. We need to all work for SASB. I'm serious. We need to promote SASB. I couldn't be more serious. If people get sued in the U.S. for not disclosing exactly what you just said, then that is going to spill over to Europe and to Asia and everywhere else in the world. And so having this materiality where they're not cherry picking the materiality and figuring out how to do it, which is your point on that, is that the cherry is totally great, I think is one of the most important things that we as a community can do right now.
So some use for the United States, after all.
I would say being an impact investor, we can play a role even if we are investing in quite early stage companies, but how we define or help them define their impact by saying that you create 1 unit of impact whenever you're growing your business forces them to analyze what you otherwise could kind of skip if you have a profit or a revenue as your final goal. So that is how you are creating your business. You need to then also report on that. How many more units of this are you creating? How are you doing that? And so on and so forth. And then, of course, stuff that does not have to do with the business model or is not as closely tied to diversity reporting and so on, that has to be just mandated from an investor perspective. I mean, for larger corporations, there needs to be regulations. For smaller companies, we as investors could really make a difference.
Can I quickly follow up? So say the company comes to you and says, okay, we would like to report this, but the numbers are looking bad. What advice would you give them?
No, if I mean, you should always. We are working. I think it's kind of unfair to compare our two situations, because I think we will have totally different answers. Not because we can afford for them to report a negative just to prove the point that this is a difficult topic, because that's kind of what we want to do. And it doesn't say anything about the value of that company because they're in that stage. So it puts even more pressure on us as early investors, because we can afford to be very provocative. We can afford to show all the failures, and then we also have the responsibility of doing that. Not saying that the other ones should cover up, but they have different responsibilities. Our main responsibility, I think, is to push people to do more, to take more risk in these early stages. Hence, we do not have to think about how we package this so much.
Yeah, and I comment there. One of our values at EQT is transparency. It's actually a very, very important one. It goes, through the whole organization. If there's some kind of problem in a company, the worst thing you can do at EQT is to hide it. You have to put it on the table, otherwise we can't deal with it. No one can help you unless you tell us what the problem is. So that would be the answer to that question. We would absolutely put it out there, report it. The good thing about that is that by the time you come to the next year's reporting, you'll probably improve, right? Because here's an opportunity actually to do something about it. So we would absolutely do that. And the other, I guess, implicit question is a little bit, well, what if management isn't telling you, or they're telling you this but not that, and so on and so forth? I mean, so the way private equity works, when we go in and do a deal, we do tons of diligence. We have a lot of advisors going in and checking everything pretty much. So we get the report, so we find out most of the things there is to know. And then we put in place a board of people who we trust and who we think can add value to the company. But they're also accountable. And they're also there because they have, a brain, and they have a lot of integrity. So if they smell a rat, they are supposed to go and look deep and dig. That's what we ask them to do for us. Because if we don't know, this thing might blow up. And that's the worst thing that can happen to us, right? If someone, hides something, and then it's in the papers the following day, and we don't know, that's really a disaster scenario. So we really encourage everyone to put everything on the table so that we can deal with it. And we don't really care if we look good or bad, as long as we can fix things. That's how we operate.
That's a very good point to end. I think Alex's businesses are supposed to be purposeful. Also, conferences and panels are supposed to be purposeful. I feel like this was very purposeful and hopefully very impactful. Thank you all for participating. Thank you, everybody, for being here today.
Thank you.